So that is what we've seen, the Econometer dipping to 249.82. Let's run through some of the factors weighing on sentiment right now.
Thank you, Alicia. I'd have to start with GDP. The concerns about global growth are starting to weigh on the local economic environment. And people are thinking that the global economy is not growing as fast as they thought a few weeks ago. If anything, right now there are more risks than there were a few months ago. So people are starting to think that, linked as we are with the global economic story, we are not going to grow as fast as we could. But they still are very close to the 4% area. And now remember, government is seeing economic growth this year at 3.4%. So a lot of them are still in the 3.4% area. And I am expecting that over the few months, we're going to start to see some of them easing those growth forecasts.
Nothing's really changed on a fundamental perspective over the last couple of weeks. So to what extent do we have to attribute this to the fact that, you've got a public that is becoming a little bit more realistic and lowering their expectations at this stage?
Exactly, that's exactly what is happening. I mean, you saw credit figures a few weeks ago that the domestic economy, the domestic consumers and companies aren't borrowing as much as they thought, as we thought, and because of that, retail sales are still sluggish. Now, we did see 9.8% year-on-year growth in April, but that was mainly due to the public holidays that we have in April. On overall, retail sales are still quite weak, and as long as retail sales are still quite weak, the local economy is going to be sluggish because you cannot have growth without that. And the manufacturing environment is also not that much better. We saw in April output growth slowed to 0.4%, and that was quite a shocker. So that's also because of the demand situation locally and the demand environment globally.
Of course, we've seen that production or output levels within the manufacturing sector decrease, and this is while costs rise as well. Indication as to what's being expected on the inflationary front?
Inflation front, there's still worries about food and oil costs. Now, we saw the government saying that the oil price, rather the petrol price locally, is going to decrease. But globally, we are still seeing those supply concerns. The Northeast and Middle East situation is still there. So the oil price is still a concern. Now, in May, we saw inflation quicken quite more than expected to 4.6%, and that was mainly because of food costs, and that is still a concern. So inflation expectations have inched up a little bit.
We're expecting a breach of that 3 to 6% target band in the first quarter of 2012. Is that being seen more as temporary or the beginning of a ticking higher still as we progress through 2012?
A lot of economists are still thinking that is going to be quite a temporary situation, because with demand environment in the country still quite sluggish, you're not going to see inflation pushing much higher than it's going to be. Now, the Reserve Bank has seen that it's going to be 6.3%, peak at 6.3% in the first quarter. So that is going to be a temporary breach of that inflation. And the Reserve Bank has said before that any signs that they see that the demand environment is pushing inflation higher, they're going to act on that, but they're not seeing that right now.
Of course, one of the factors that has cushioned the local economy from higher inflation than we're seeing at this stage is a stronger rand. It's cushioned against the impact of higher global oil and food prices that you've highlighted. It's gained 13% over the 12 months, and many expecting it to stay stronger for longer.
Yes.
Is this in line with what the surveys revealed?
Certainly. And the overarching story with the rand is stronger for longer, is resilience, and what we've seen so far this year, and it's going to continue. Part of that reason is that monetary policy in developed economies is still quite loose, and as long as that much liquidity in the global economy, foreigners are coming into South Africa, buying South African bonds, buying South African stocks, especially South African bonds. So as long as that is the story, the rand is continuing to at least hold its gains and hold its own. Now, among emerging market currencies tracked by Reuters, the rand is in the top 3 performers against the dollar. So it's quite a good story for the rand, and it really has helped on the inflation front. And it's also one of the reasons why manufacturers are under such pressure.
Well, we've got the rand currently trading at around about that 673 level at this stage of the game. What kind of trading range has been pegged out by those that have been surveyed in this econometer?
I think going until they're expecting that it's going to end the year around 710, and I always say this, that the rand is a very heavily traded currency in globally, and more of the rand trading is abroad than locally. So 710 is still within current ranges, but there is still that chance that if we see the rand go below 670 on a sustained basis, then we could see it go to the 650s.
All of this, Phumza, spelling what for interest rate direction forecast, because the bank is in a difficult position given the fact that we've got high inflation to contend with on the other side, but then lingering downside growth risks on the other hand.
Certainly, and the bank is quite cognizant of this. Now, rhetoric that we've seen from the bank in the past few weeks, we had Chief Economist Macanda saying that the Reserve Bank is not going to start raising interest rates just because of cost push pressures, which is your food and your oil and your administered prices. It will only start doing that when it sees demand starting to push inflation up, and that is not the case right now. So a lot more economists than last month have started to think that, you know what, they've pushed forward into next year the start of the monetary tightening cycle. And even then, we're seeing 200 basis points by the end of next year and another 150 basis points a year after. So we're going to be watching that monetary policy statement quite closely a week after next to see what the bank, where the bank is leaning towards. Are they still sort of dovish? How concerned are they about the economy? What do they think about consumer expenditure?